BlackRock is the largest asset manager in the world, with over $9 trillion in assets under management. BlackRock is also one of the world's largest owner of stocks, and has nearly $3.5 trillion invested in the stock market. Every quarter, BlackRock files a 13F, which updates the public on what it holds and all of the investment moves that it is making. It is very interesting to see what BlackRock is buying and selling within its massive portfolio. And in today's video, we're going to be discussing the top 5 stocks that BlackRock is buying now. Before we get into the stocks that BlackRock is buying though, I just want to let you all know that Stock Unlock's 30% off discount is ending tomorrow. If you have been waiting to check out Stock Unlock or have been considering a subscription, then now is the time to act. The sale ends at midnight tomorrow, so do not wait and go sign up. Stock Unlock is the portfolio tracking and stock analysis platform that I use here on my channel, and with the discount you can get it for under $6 per month. All you need to do is use the code BF30 at checkout to apply the discount. And again, this sale is about to end. With that being said, let's dive into the stocks BlackRock has been buying. Number 1 is Kenvue, with the ticker symbol KVUE. BlackRock has increased its position in this business by 1,461% and now owns $2 billion worth of its shares. This stock is interesting because it is a recent spin-off from Johnson & Johnson. I always love looking into spin-offs because they typically are well-financed companies that the parent company wants to see succeed and still owns a large position in. Therefore, it is in the parent company's best interest to see the spin-off succeed and set it up for long-term success. Peter Lynch has also said spin-off divisions or parts of companies into separate, freestanding entities often result in outstandingly lucrative investments. So for me, I always like to pay attention to spun-off businesses, and I own a few of them in my own portfolio. Kenvue became its own company in May of this year, and since then has seen consistent selling. The stock is down 25% since its IPO, and it looks like BlackRock has used this as an opportunity to buy more shares. Kenvue also owns many well-known consumer brands like Tylenol, Listerine, and Aveeno, which almost everyone knows and uses. However, in Kenvue's most recent earnings report, it showed that its operating margins are down year over year. The business has also lowered its guidance for 2023 for both revenue and earnings per share. So it looks like the business is seeing increased costs and lower sales, which is impacting its bottom line. This could also be the reason for the stock's recent sell-off as well. However, sales did still grow 3.3% year over year, and its operating cash flows grew 18% to $2.2 billion year to date. Its capital expenditures are also only $246 million, which means the business has produced roughly $2 billion in free cash flow so far this year. It also has very low stock-based compensation of $75 million, which suggests that this business is not diluting its shareholders excessively to pay the insiders. Kenvue's price to free cash flow is also well below its peers like Johnson & Johnson and Procter & Gamble. These businesses are selling in the 23 range, whereas Kenvue is only selling for a price to free cash flow of 13, which is also a free cash flow yield of 7.5%. Since 2017, these larger businesses have had similar revenue growth rates as well. So it seems like all three businesses have similar growth rates, but Kenvue is selling for a significantly lower price. It seems like a solid business with strong consumer brands. However, it personally does not excite me that much. I think its brands are very strong and the business will continue to generate cash flow over the longer term. I just don't think that it will provide strong growth, and that there are better investment opportunities out there in the market. It could be one to put on a watch list though, as it does look like it is selling for a lower price than its peers. The next stock on the list is Blackstone, with BlackRock increasing its position by 29%. Blackstone is an alternative asset manager with over $1 trillion in assets under management, and it is very similar to Brookfield. The stock has historically performed very well and outperformed the S&P 500 by a wide margin. Its stock is currently in a 29% correction as well, so it looks like BlackRock has been buying the dip on this one too. Its assets are mainly real estate, private equity, and insurance, and each one of these segments has roughly $300 billion of assets under management. Blackstone also has $200 billion of cash available to deploy, which suggests that it is sitting on a large amount of dry powder that it can opportunistically use to buy assets. For example, the real estate market has been taking a beating, and BlackRock has $66 billion that it can deploy to take advantage of opportunities that may arise in the real estate sector. So it looks like Blackstone could be buying more BlackRock during the dip, while the company is also sitting on tons of cash to deploy. However, these alternative asset managers are typically very challenging businesses to understand. So personally, I think that I have my hands full with Brookfield as it is. The stock does also have a long track record of great performance, so it could be another great research candidate. The third stock that BlackRock has been buying is Extra Space Storage, increasing its position by 53% to $2.52 billion. This is a self-storage REIT that has historically outperformed the S&P 500 by a wide margin as well. Interestingly, this stock is also in a quite large correction of 44%. So once again, it looks like BlackRock is buying the dip on this one. What's interesting about the self-storage industry is that it has historically been the fastest growing REIT sector, producing average returns of 17% over the past 29 years. It has also had the highest returns during the worst return periods for overall real estate. The worst 5-year period for the self-storage industry was 4.7%. What's driving these returns is the increased demand for self-storage. For example, in 2020, 10.6% of US households were utilizing self-storage, which was up 400% from 1988. So as time passes, more and more people seem to be using self-storage. Now getting into EXR's fundamentals, it has historically outperformed the industry as well, and has produced more revenue growth than the sector's average. However, the sector does look like it has boom and bust cycles depending on what the overall economy is doing. For example, in 2009, the sector saw a decline in revenues, and then the same thing happened in 2020. However, the business and the sector also recently saw a massive surge in revenue from 2021 to 2022. Its quarterly revenue is at an all-time high still, but you can see that over the past 4 quarters, its revenue growth has slowed down significantly. Additionally, its operating cash flows have been topping out. Vacancy levels are also back to 2019 levels, which means that they have been dropping over the past few years quite substantially. So there does seem to be some short-term headwinds in the self-storage space and real estate in general, with rising interest rates and a weaker consumer. However, the long-term growth of Extra Storage has been incredible, and its stock price is arguably factoring in all of these headwinds already. It looks like BlackRock is using the sell-off in the stock to increase its position in EXR, and honestly, I can see why. Now, the fourth stock that BlackRock has been buying is Airbnb, increasing its position by 36% to $3.5 billion. Airbnb is a brand that we all know and probably use, and the company IPO'd in 2020, but since then, the stock has been basically flat. On Stock Unlock, Airbnb has very highly rated metrics as well. For example, its financial health score is 4.2, and the company has more cash than current liabilities. Its growth and profitability scores are also very high at 4.75 and 4.60 respectively. The business has been seeing its revenues and profits grow and has a free cash flow margin of 44%, which means that the business is incredibly profitable. Free cash flow is also at an all-time high and continuing to trend upwards. Now, what's interesting about Airbnb is that its price to free cash flow is only 19.7, which is a free cash flow yield of about 5%. This is not a very high price to free cash flow for a business that is growing this well and has such high profit margins. For example, Procter & Gamble and Johnson & Johnson are selling for higher price ratios while producing less growth and having significantly lower margins. Therefore, it looks like Airbnb could be selling for an arguably attractive price today. However, there is fear in the overall travel and real estate sectors, which could be causing people to avoid the stock right now. For example, New York has recently banned short-term rentals, and people are worried that this policy could spread to more cities. Consumer finances are also reported to be getting worse, which means people may not be traveling as much in the near future, which could harm Airbnb's growth. But so far, these headwinds have not reflected in Airbnb's fundamentals, as its revenue and free cash flow are both at all-time highs and continuing to grow and trend upwards. So far, it seems like these fears towards Airbnb are unfounded, and the stock is trading for a seemingly low price today. So once again, it is not hard to see why BlackRock has been buying more Airbnb. Now, the last stock that BlackRock has been buying is Eli Lilly, and they have increased their position by 1.9%. Eli Lilly is a pharmaceuticals company and is the only stock on this list that is not currently in a significant dip. In fact, the stock is selling right near all-time highs and has produced absolutely incredible returns over the past 15 years. Now, the reason I think BlackRock is buying is because Eli Lilly recently announced positive results from its Alzheimer's drug trials. In May of this year, it announced that its donanemab drug significantly slowed cognitive decline in Alzheimer's patients. I also recently watched an interview of BlackRock's CEO, Larry Fink, and he said that he is very optimistic on the future of the world, partly because these advances in medicine. So it sounds like BlackRock is very bullish on Eli Lilly and believes the company will do well over the long term. However, Eli Lilly's valuation today is astronomical. Its price to operating income was hovering around 20 from 2014 to 2020. However, since the pandemic, it's skyrocketed to an all-time high of 60. Even on a price to sales basis, which is my least favorite metric to use by the way, the company is selling very high. It's currently at nearly 18 times sales, which is an insanely high price to pay for any business. And in 2018, its price to sales was only 4. If we take a look at where its historical returns have come from over the past decade, we can see the share price has produced a compounded annual growth rate of 25%. However, its price to operating income has grown by 16% annually over this period, whereas its operating income has only grown by 5.5% annually. This means that the vast majority of Eli Lilly's returns have come from multiple expansion over the past decade and not from underlying fundamental growth. It may have a huge new drug, but the stock price is already reflecting a significant amount of growth, which means that future growth is already priced in today. So personally, this business is just way too expensive for me to be interested in, as I think the price today carries a large amount of risk. For me, the most interesting stocks on this list are EXR and Airbnb. I could be more interested in Blackstone as it is an alternative asset manager like Brookfield, but these businesses tend to be very challenging to understand, and I do not want to go and learn another one right now. EXR is in a huge correction due to some short-term industry headwinds, but over the longer term, I do expect this business to be fine and continue growing. Airbnb is extremely profitable with a strong management team and a very well-known brand across the world. It also isn't selling for an insane price today, so I think that this one would be worth exploring as well. But let me know what your favorite stocks are from this list in the comment sections below. Also, make sure you head over to Stock Unlock and use the code BF30 at checkout to get our 30% off pricing right now. Once again, this discount ends tomorrow, so do not wait. But with that being said, thank you all so much for watching. As always, I truly do appreciate it, and I really hope to see you all again in my next video.